Hi guys, welcome back to the channel. My name is Dave, and today we're talking about ETFs and options, getting together, having a great time. And I hear a lot, I'm waiting for this dip to occur, then I'm going to buy. But, with ETFs and options getting together, we don't have to wait for the dip. We can actually create our own dip. So today we're going to talk about how to create a dip ourselves. If that's what you're looking for, please stick around. Whoop! Over the last 10 years, ETFs have had great returns, and like VOO, the S&P 500 index fund that I like to buy, that's returned 26% year to date and 33% over the last 52 weeks. That's outstanding. If you've been putting your money in there, you've had great success. But that doesn't mean we know what's going to happen over the next 52 weeks, and that really scares people because now they're thinking, oh my gosh, do I want to really buy? Do I want to put my money in here at the very top of the market? So today I want to kind of show you a technique that I like to use when I'm looking at these, and I have that little bit of fear that I don't want to put all my money in at the top of the market. So today we're going to try to do two things with this type of trade. We're going to activate our money, get it off the sidelines and put it to work right now, which is really important. And then number two, we're going to try to buy this ETF at a reduced cost basis. We want to not buy at the very top of the market, feel like we're buying a little bit of a dip. So if we can accomplish those things, I'm going to feel pretty good about this. And that's how I approach these types of buy and hold positions with the VOO and other ETFs that I want to hold forever. For me, ETFs have definitely become a core part of my portfolio, and I think it's a great way to grow your portfolio too. Just buy and hold these long term. They certainly have been a great investment over the last 10 years. We'll see what the future holds. Maybe the next 10 years will be just as good. Not sure yet. We'll find out. But one of the best things about them is they reduce volatility. So emotions can really creep in when you go and you buy a stock. Let's say you buy Microsoft today, drops 5% tomorrow on bad news. Oh, you feel horrible. But if you own that within an ETF and maybe Apple comes out with good news and it shoots up 5% and they're equally weighted in this ETF, well, ETF just does the shoulder shrug, right? And it continues to move along up and to the right, hopefully over a long period of time. So it really takes big macro trends to move these things significantly in one direction or another. Typically, you're not going to see that 10% change today and 10% change tomorrow. So emotionally, it's really not, you're not investing nearly as much. Also, if you are buying routinely, dollar cost averaging into these, or you're trading options against these, there's also the fact that you're just reducing all the variables. So you don't have to worry about what's happening over there with Tesla and over there with Microsoft and Apple over there, tracking all these different items together, because really you're looking at the whole core market with something like VOO, for example. So you don't have to worry about so many variables. It makes options trading much simpler, easier to get into and understand. So I'll link my video above, my 4 favorite ETFs. I did this video about a week ago. But all of these will allow you to trade options against them. But they're only going to have expirations once per month. So keep that in mind. Now, there are a few that trade weekly with weekly expirations. I'll put a picture up here now of those. But just keep in mind that many of them only expire once a month. There's also the mothership of all of these, which is SPY, which has multiple expirations every week. So if you really want to do options for income kind of trading, then your best bets are going to be SPY and QQQ, because these are going to have the most open interest, meaning they're going to have the smallest bid and ask spread. They're going to be the easiest to trade and jump in and out of. So if that's really your goal, which isn't what I'm going to show you today, SPY and QQQ are your go-tos. And just as an example, a lot of people just go with SPY and they just focus on that. And that's what they're trying to generate income off of. And they'll do credit spreads and things like that. So if you're really serious about it, you can go out and do some of your own research and start really looking and focusing in on SPY. Because just like I mentioned earlier, and this is huge, if we can reduce the number of variables, we're going to have a better opportunity to be successful when it comes to options trading in general. That's my belief. So what I want to show you now is 2 conservative ways that you can utilize options to get into long-term positions within ETFs. I'll also mention a third way at the end that we're going to save the bulk of that video for a future date, but it should address one problem that we'll encounter and talk about along the way. So the first way I want to show you today that we can buy the dip essentially and put our money to work right away is by selling a put either at the money or out of the money on one of these ETFs that you like. So for those that are brand new to options, I would consider this a conservative approach to using options. So and I want you to try to understand where I'm coming from. The drawback here, though, which I'll point out right up front, is that with a strike price of $430, if this does get put to us, we're going to need $43,000 of collateral to buy this. So that's one of the reasons I'm using VOO, is it's so expensive, but you can find less expensive ones, and I'll show you some examples of that later. But let's talk through this trade because I think it illustrates it pretty well. So this is VOO, it's a put. I'm selling to open one contract. I'm selling a contract to somebody else with an expiration of January 21, 2022. So at about 6 weeks from now. And the strike price is $430. So we would call this at the money, pretty close to at the money. And it's a put contract, so they're going to get put to us if this expires under 430, right? And for doing that, we get to put money in our pocket right now because there's a fee for selling this, right? We get to charge them a fee. We get to put this premium, that we like to call it, this $780 between this bid and ask. So it's probably going to be about $800. We get to put in our pocket right now. At market, it's $780, but essentially it's about somewhere between this bid and ask. So let's call it $800. For sake of argument, okay, so if you take that $800 away from this 430 strike price, we're going to get our break even of $422, okay? So that's our break even. So if this thing does pull back, we're essentially buying it at $422 because that's our break even. Okay, so if we look at a chart of VOO and we go out here and we go, where's 422? It's right here. And recently everybody was talking about this dip we just had. Oh, did we time that dip? Did we buy that dip? Well, we can buy that dip right now. We can buy it for $422. Not a problem at all with the use of these types of options. So, and if that's not good enough, guess what? I've got an answer for you. All right, so let's go back over here and say that dip was not dippy enough for me. So I'm going to go even deeper into it. I'm going to go to 420. And at 420, you're going to get $520 still that you're going to put in your pocket right now. So our break even for this would be 420 minus the 5. So it's under 415 for our break even. Pretty darn good now, right? If we go back over to our chart and we say, where's 415? Ooh, that's right at the bottom of that dip. I nailed it. I can make this trade right now and I can buy that dip? Yes, sir. Yes, you can. So with this trade right here, you're going to put $520 in your pocket or so. And you're going to only keep this if it falls below 420. But even if it falls to 420, and you still have this extra $500. So that's why your break even is so low. So this is an example of selling a put at the money or out of the money, where you can put this in your pocket right now and essentially buy that dip. But the great thing too is you're activating your money. So if you have $42,000 lying around, you can make this trade right now and have that collateral sitting there ready to go. So let's talk through some other scenarios that could happen with this trade. Now this could go and VOO could continue to take off. Maybe it goes to 450. In that case, you just keep your $520 and you're gonna have to chase this higher and maybe sell another put and try to buy the dip at a future date at maybe 430 or 440, for example. So that's if it goes higher. If it just trades flat, guess what? We can repeat the exact same thing and continue to put money in our pocket, or we could buy it at its current price, knowing that we're still kind of about the dip because we got that money up front initially anyway. So the only way we're actually going to buy this, if it does fall below 420 by expiration. And if it does do that, we bought the dip, right? That was kind of our goal. We didn't want to buy at the top of the market, and we didn't. We're buying it at 420. So hopefully you understand why I consider this a conservative idea and one that might put your mind at ease about buying at the top of the market. And just to show you that I do these types of trades myself, here are 3 examples that I have live right now. VOO, VUG, VYM. Should sound familiar if we watched my video that I posted before about my 4 favorite ETFs. So these are ones that I like to buy and hold and add to these positions. Although all these are moving in the right direction right now as far as away from my put position, so it looks like I'm just going to continue to collect the premium. I'll continue to probably chase these a little bit higher and trying to grab these long term. But just to show you some examples of what I have out there right now and in play myself. Okay, so a second example here is if you were going to be doing a covered call type of strategy. And first off, I'm going to link a couple videos above that you can go back and reference this so you can understand what a covered call is if you're not familiar, and also about in the money covered calls, because this adds a little complexity to it. So we're going to set this up. We're going to do it with SPLG, which is essentially VOO offered by another company. Right? But it's an S&P 500 ETF. But look at the price. It's only $5,525 to buy 100 shares versus that $42,000 or $43,000 for VOO. So much more palatable, right? Maybe we can afford to do that with this particular ETF. So just to show that there are other options out there for ETFs that essentially do the same exact thing. So in this case, it's SPLG. It's a call. We're selling to open one contract, same expiration January 21 of next year, at a $54 strike price, and it's a call option. And by selling this, we're going to collect a premium right now after buying those shares and turning around and selling this call. We're going to collect about $185. Probably be closer to $200, but let's just say it's at $185. So what have we just done? Well, we put $185 in our pocket, right? So if we play out through this, what are the possibilities? Well, I know the first thing that might, if you're catching on to this is I just paid $5,525 and I'm offering to sell it for $54 by this date. Well, why aren't they just going to turn around and grab it, right? So you have to understand that the difference between here, right, is $125 and you're getting $185, right? So that's a difference of $60. So you have an extra $60 to play with here. So if this just continues to go up, right, it's going to get called away from you eventually for $54 a share, right? But you're going to make $60 because of the difference between those numbers. Not too bad, right? You put $60 and you walk away. But what we're really hoping here is to buy this on the dip, essentially. So we're hoping that the market pulls back. And if it does pull back and goes underneath this $54 and eventually expires at, let's say, $53.50, are we okay? Did we buy the dip? Yes, because we got it for $55.25. And if you take away this $1.85 that you get from this, right, where are you at? You're down well below, let's see, 185, 55.25. You're essentially at $53.40 as your break even. So you're buying that dip. So even if it goes down to $53.40 at expiration and you end up keeping the stock at that point, that's at your break even. So you've essentially done the same thing. We bought the dip. We're right at break even at $53.40. So again, you can check your chart out and see if you feel good about that dip. And that's the other example. This is just the covered call version of the same thing. But why would somebody do this versus the other one? The reason might be because you want to own the stock right now. Maybe an upcoming dividend is pending and you want to own the stock right now and try to grab that dividend. So that might be a good example of why you would do this strategy over the other one. And also with consideration of SPLG being a lot less money, so easier to trade. And the third way we could go about this, and we're just going to touch on this real briefly, would be to set this SPLG or VOO or any other ETF that you'd like up as a poor man's covered call. And with a poor man's covered call, we're going to essentially do the same thing, but we're going to synthetically buy these shares. So when we do that, we're going to buy a very deep in the money call that's going to kind of synthetically represent our $5,525 of 100 shares. So by doing that and doing that as a call, we're going to be able to reduce this upfront cost. So if this is still a struggle where you can't spend $5,525 to do a covered call like this, you can do this as a poor man's covered call. And it is a more complex trade and something that we're going to get into in more depth in an individual video so that we can really pick it apart. Because this isn't, I wouldn't say a poor man's covered call should be your first options trade. So if you're struggling with either of the things we've talked about so far, you don't even want to go down this route yet. We'll save that for a different video in the future. But you might start doing a little bit of review. Look up poor man's covered calls. So there you go, 2.5 ways that we can use options to buy into ETFs long term, where we will not be buying at the very top of the market. We're essentially buying the dip, right? That's what we're really trying to do here. Put some money in our pocket, activate our money right now. So hopefully that fills in some blanks. And again, a conservative way to get into this if you're like me and you want to buy and hold ETFs for the long term. Now, if you have any questions about this, please ask down below. Happy to answer your questions. If you wouldn't mind, please like and subscribe. If you're looking for content like this, we'll have more coming out in the future. Really appreciate you spending some time with me. Have a great night. Take care. Whoop.